The U.S. housing market just hit a milestone nobody expected. Mortgage rates dropped below 6% for the first time since 2022. Home prices have risen for 31 consecutive months. And yet, inventory is surging 20% year over year. So what's actually happening? Is the market finally turning in buyers' favor? Or is this just the calm before something bigger? Today, we're cutting through the noise. Welcome to Property Ranked, no predictions, where we analyze real estate markets using real data. This is our Q1 2026 housing market report, covering home prices, inventory levels, mortgage rates, regional performance, new construction, and what leading economists are actually forecasting. Whether you're an investor timing your next move, a first-time buyer waiting for the right moment, or a homeowner wondering if you should sell, this is the data you need. Let's start with the number everyone watches first. The median existing home price in January 2026 was $396,800. That's up 0.9% from January 2025, marking the 31st consecutive month of year-over-year price increases. But here's what the headlines miss. The pace of growth has dramatically slowed. During the pandemic, home prices surged 15 to 20% annually. Now we're looking at under 1%. In real terms, adjusted for inflation, home prices are essentially flat, and the forecasts suggest this is the new normal. Redfin projects just 1% growth for all of 2026. Zillow says 1.2%, and JP Morgan Global Research goes even further, calling for 0%, completely stagnant prices nationally. The consensus is clear. The days of double-digit appreciation are over. Home prices aren't crashing, but they're not climbing either. And for the first time since the Great Recession, incomes are growing faster than home prices. That's a fundamental shift. Now here's where it gets interesting. Total unsold inventory hit 1.22 million units in January. That's 3.7 months of supply. A year ago, it was closer to 3 months. That 20% increase sounds dramatic, and it is the fastest inventory growth since the pandemic recovery began. But context matters. A balanced market typically has 5 to 6 months of supply. We're still well below that threshold. And nationally, active listings are still 17.8% below where they were in January 2019, before the pandemic even started. So are buyers getting more choices? Yes, absolutely. Inventory is up in 41 states. But are we back to normal? Not even close. The market has gone from severely undersupplied to moderately undersupplied. That's progress. But it's not the buyer's market some headlines suggest. However, 9 states have already exceeded their pre-pandemic inventory levels: Arizona, Colorado, Florida, Idaho, Nebraska, Tennessee, Texas, Utah, and Washington. If you're buying in those states, you have the most negotiating power we've seen in years. The 30-year fixed-rate mortgage averaged 5.98% as of February 26, 2026. That's below the 6% barrier for the first time since September 2022. A year ago, rates were at 6.76%. So we've seen a meaningful drop, almost 80 basis points in 12 months. To put that in dollar terms, on a $400,000 home with 20% down, today's rate saves you roughly $170 per month compared to where we were last February. That's over $2,000 per year. But here's the reality check. The Mortgage Bankers Association, Fannie Mae, and most forecasters expect rates to hover around 6% for most of 2026 and into 2027. The era of 3% mortgages is not coming back. The Federal Reserve has signaled a cautious approach to rate cuts, and the 10-year Treasury yield, which drives mortgage rates, remains elevated by historical standards. So while affordability is improving, don't expect a dramatic rate plunge. Monthly mortgage payments are, however, expected to decline for the first time since 2020. Combined with wage growth, the National Association of Realtors says housing is now the most affordable it's been since March 2022. For the past 3 years, the mortgage lock-in effect has been the single biggest force shaping the housing market. Tens of millions of homeowners locked in rates below 3% during 2020 and 2021. And selling means giving up that rate for something double the cost. The result? A frozen market. Existing homeowners refused to sell, inventory stayed low, and first-time buyers had almost nothing to choose from. But here's the turning point. By early 2026, the share of homeowners with mortgage rates above 6% has officially surpassed the share with rates below 3%. The lock-in effect is melting. Not overnight. This is a gradual thaw. But the math is changing. Millions of homeowners who took out mortgages at 7.5% or 8% in 2023 and 2024 are now in the refinance zone. As more people hold mortgages closer to the current market rate, the financial penalty for moving disappears. Redfin calls this part of the Great Housing Reset, a years-long period of normalization that they estimate will take roughly 5 years to fully play out. Now here's where the national averages completely break down. The 2026 housing market is defined by a stark regional divide, and if you're making investment decisions based on national data alone, you're flying blind. The winners? Rust Belt and Northeast cities. Cleveland led all markets with 4.5% annual price growth. Hartford, Connecticut came in at 4.4%. Milwaukee at 4%. Buffalo and Chicago both at 3.7%. These markets share a common trait: severely limited supply and steady local demand. They never saw the pandemic construction boom, so they never built the excess inventory that's now weighing on Sun Belt markets. Speaking of the Sun Belt, that's where the pain is concentrated. Florida, Texas, and Arizona all faced decade-high inventory levels after the pandemic building frenzy. The metros with the steepest inventory declines: Raleigh dropped 23%, Las Vegas fell 22.8%, and Charlotte slid nearly 20%. California isn't doing much better, with 11 cities ranking in the bottom 20 markets nationally. For investors, this regional divide creates both risk and opportunity. The Midwest offers stable cash flow with appreciation. The Sun Belt offers potential value plays, but only if you understand where the oversupply is concentrated and how long it takes to absorb. On the supply side, new construction tells a cautious story. An estimated 1.36 million housing units were started in 2025, down slightly from 2024. Building permits are running at 1.45 million annually, which is a modest increase, but well below the levels needed to close the national housing deficit. The National Association of Home Builders projects 1.05 million new homes in 2026, up 4% from last year. But here's the structural problem. The U.S. is estimated to be short between 3 and 7 million housing units, depending on which study you cite. At current construction rates, it would take decades to close that gap. Single-family construction is tepid. Builders are cautious about demand with rates still near 6% and buyer hesitation in many markets. Multifamily construction is actually leading the sector, with apartment completions running at some of the highest levels in decades. For investors, this supply deficit is the fundamental reason home prices haven't crashed despite affordability challenges. There simply aren't enough homes. So where do the experts think we're headed? Let's lay out the forecast from the organizations that matter most. Redfin predicts 4.2 million existing home sales in 2026, up 3% from 2025. They expect the median home price to rise just 1%, and call this the beginning of a great housing reset that will take 5 years. Zillow projects 4.26 million sales, up 4.3%, with home values rising 1.2%. They also forecast the number of major markets seeing price declines will drop from 24 to just 12. The National Association of Realtors is slightly more bullish, projecting home price growth of 2 to 3%, roughly matching consumer inflation. And JP Morgan Global Research stands alone with a 0% price forecast, arguing that increased supply will exactly offset improved demand. What all forecasters agree on is this: sales volume will increase, affordability will improve, and the market is normalizing, slowly. Nobody is calling for a crash, but nobody is calling for a boom either. This is what a soft landing looks like for housing. So what does all of this mean if you're investing in real estate in 2026? Here are 5 data-driven takeaways. First, appreciation is not your strategy anymore. With prices flat to 1% growth nationally, your returns must come from cash flow, not price speculation. Second, regional selection matters more than ever. The spread between the best and worst performing markets is enormous. Midwest cities offer stability. Sun Belt markets offer potential entry points, but only after careful due diligence. Third, the lock-in thaw is creating inventory. As more homeowners become willing to sell, you'll see properties that have been off-market for years. Be ready to move. Fourth, interest rates near 6% are the new baseline. Don't wait for 3% to come back. Underwrite your deals at today's rates, and everything above is a bonus. Fifth, the housing deficit is structural. 3 to 7 million units short. This floor under prices isn't going away in our lifetime. Real estate remains a fundamentally supply-constrained asset class. The market is resetting, not collapsing. And for disciplined investors, resets create the best buying opportunities. That's the 2026 housing market. No hype, just data. If this analysis helped you make a smarter decision, hit subscribe and turn on notifications. We publish data-driven real estate analysis twice a week. Drop a comment telling us which market you're watching most closely. And if you want to see how specific markets stack up, check out our city-by-city breakdowns in the playlist below. See you in the